Welcome, everyone. So, throughout our course on accounting for decision making, we've been hammering home this idea that financial statements, well, they're the language of business, right? They tell a story. But if you really want to understand the plot, the real strategy, the true ambition, the health of a company, you've got to learn how to read between the lines. And today, we're going to do a deep dive into one of the most revealing lines in that entire story: retained earnings. And I really want to stress this. Getting a solid grasp on this one concept isn't just about getting a good grade in this class. It is an absolutely essential tool for making smart business decisions, whether you end up as a manager, an investor, or you go out and start your own company. Okay, so let's frame our entire discussion today around this one fundamental question. A company has a great year, all the bills are paid, and there's a net profit on the bottom line. So, where does that money go? This isn't a trick question. The answer to this is what defines a company's entire strategy for the future. You see, a profitable company basically has two main choices. Does it distribute that profit back to its owners, the shareholders, in the form of a dividend? Or does it retain that profit, effectively betting on itself and reinvesting that money for future growth? This decision, this tension between distributing and retaining, is really at the core of corporate finance, and it's all captured in the specific account we're going to unpack today. So let's get the formal textbook definition up here, but I want us to really break it down word by word. Retained earnings is the cumulative amount of net income that a company retains after paying dividends. Let's deconstruct that. Net income, we know that's the bottom line profit from the income statement. Dividends, that's the slice of the pie that gets handed out to shareholders as a return on their investment. But the most critical word on this slide, the one I want you to underline in your notes, is cumulative. This is so important. This number isn't just a snapshot of one quarter or 1 year. It is a running total, an accumulation of every single dollar of profit the company has earned and decided to keep in the business since the day it started. Think of it like a company's financial memory. It's a historical record of its ability to create and hold on to value over its entire lifetime. Okay, so where do we actually find this incredibly important number? Well, you're going to find it on the balance sheet, and it lives in a very specific neighborhood, the shareholders' equity section. Now, let's just quickly recall our fundamental accounting equation. Assets equals liabilities plus shareholders' equity. Assets are everything the company owns. Liabilities are what it owes to outsiders. And shareholders' equity, well, that's what's left over for the owners. Now, inside that equity section, you'll see things like common stock, which represents the money that shareholders initially invested into the company. But retained earnings is different. This represents the owner's claim on the business that was generated internally from the company's own profitable activities. It's the value the company has built for itself. It's a powerful form of self-financing. This little formula you see right here, think of it as the engine. It's the mechanism that drives the change in the retained earnings account from one period to the next. Let's walk through it nice and slow. First, you start with the retained earnings balance from the end of the last period. That's your starting point. Step 2, you add in the net income that the company generated this period. You literally pull that number right off the bottom of the income statement. That's the new value created. Step 3, you subtract any dividends that were paid out to shareholders. That's the value that was distributed. And what are you left with? Step 4, your ending retained earnings. This is the new number that will show up on this period's balance sheet. This simple calculation is the bridge that directly connects the company's performance, the income statement, to its financial position, the balance sheet. Now, this slide here, this perfectly visualizes that bridge concept we were just talking about. Remember, the income statement measures performance over a period of time, like a quarter or a year. The balance sheet, on the other hand, is a snapshot at a single point in time. So how does the story of the year connect to the snapshot at the end? Retained earnings is the answer. In fact, many companies even prepare a separate financial report called the Statement of Retained Earnings that just shows this one calculation. When a company has a positive net income, that profit flows right across that bridge. It increases the retained earnings account, and that strengthens the overall shareholders' equity. But the opposite is also true. A net loss acts like a wrecking ball. It comes in, depletes retained earnings, and weakens the whole financial foundation of the company. It is a direct, mechanical cause and effect relationship. So this brings us to the most important question of all, the so what question. As future managers, investors, and entrepreneurs, why do we care so much about this one account? We care because retained earnings represents potential. It is the company's war chest. It's the pool of financial resources it has generated and kept specifically to fund its own future. I mean, think about the other ways you can fund growth, right? You can take on debt, but that comes with interest payments and restrictions. You can issue more stock, but that dilutes the ownership for everyone who's already there. Retained earnings is the third way.
It's internally generated capital. It's the fuel for growth and innovation that doesn't require going to a bank or asking your shareholders for more cash. A healthy, growing retained earnings balance is a huge signal that a company is self-sustaining and has the financial horsepower to make its big plans a reality.
And this slide right here perfectly illustrates what that reinvestment actually looks like in the real world. This isn't abstract, it's capital budgeting in action. Imagine you're the CEO and you're looking at this treasure chest of retained earnings. You have to ask, where can we put this money to work to get the highest possible future returns? For a tech company like Apple, that money is going straight into R&D for the next iPhone. For a retailer like Starbucks, it's the cash to build new coffee shops in new countries. For a manufacturing company, it could mean upgrading a factory with robots to become more efficient. Or it could be used defensively, like paying down debt to make the company safer. It could even be used offensively to go out and acquire a competitor. How a management team decides to allocate these retained earnings is truly one of the most critical strategic choices they make year after year.
All right, now, I need everyone to pay very close attention here because this is where a lot of students, and frankly, a lot of people in the business world, make huge mistakes. Let's clear up two massive misconceptions. First, and I cannot say this enough, retained earnings is not cash. It is not a pile of money sitting in a checking account. That capital has almost certainly been spent and reinvested into the very assets we just talked about: new factories, better technology, more inventory. The retained earnings account on the balance sheet is simply an accounting record, an equity claim on those assets. It's a historical marker, not a liquid fund. Second, a huge retained earnings balance is not automatically a good thing. Think about it. If a company is just hoarding capital, piling it up, but isn't actually earning a good return on it, that's a sign of poor management. A smart investor would say, hey, if you can't use that money to grow, you should give it back to me as a dividend, and I'll invest it somewhere else for a better return. The question isn't just how much did you keep? The real question is, how effectively are you using the money you kept? That's where metrics like return on equity become so important.
So let's end our session with this thought exercise. I want you to put on your analyst hat. When you're looking at a company and you see a large and consistently growing retained earnings balance, what story does that tell you? It tells you that this is a company that is not only consistently profitable, but that its leadership believes the absolute best investment in the world is right back inside its own operations. It signals a corporate strategy that is laser-focused on long-term, self-funded growth. Compare a company like Tesla, which for years retained practically every dollar to build new factories and fund R&D, with a mature utility company that pays out most of its profits as dividends because its growth opportunities are pretty limited. Their retained earnings policies tell you everything you need to know about their strategy. Analyzing this one number gives you this profound insight into the mind of management and the future direction of the whole company. Remember that. This is a powerful tool for your toolkit.